A debenture is a type of debt instrument that companies and governments use to raise capital. Unlike secured bonds, debentures are unique because they are unsecured. This means they are not backed by any collateral such as property or other assets. Investors lend money based solely on the issuer's creditworthiness and reputation. Think of it like lending money to a friend whom you trust to repay you. However, you don't have any collateral to back up the loan if they fail to repay. This is similar to how debentures work in the financial world. Because debentures are unsecured, they typically offer higher interest rates than secured bonds. This higher interest rate compensates investors for the added risk they are taking on. Debentures are a popular way for companies to raise money because they offer flexibility. They do not require asset collateralization, making them easier to issue. Debentures are issued with a fixed interest rate and a specific maturity date. The issuer agrees to make regular interest payments to the debenture holders. Additionally, they promise to repay the principal amount on the maturity date. This makes debentures an attractive option for both issuers and investors. Understanding how debentures work can help you make informed investment decisions. There are several types of debentures, each with unique characteristics that cater to different financial needs and strategies. These variations provide flexibility for both issuers and investors, allowing them to choose the best option for their financial goals. Convertible debentures. These debentures can be converted into equity shares of the issuing company. This conversion happens after a certain period, providing investors with the potential for capital appreciation. Investors have the option to become shareholders, which can be advantageous if the company's stock performs well. Non-convertible debentures. These debentures cannot be converted into equity shares. They remain as debt instruments until maturity, providing a steady stream of interest income. Redeemable debentures. These debentures have a specific maturity date at which the principal amount is repaid to the investor. The issuer repays the principal amount on that date, ensuring a return of the initial investment. Irredeemable debentures. These debentures do not have a fixed maturity date and are also known as perpetual debentures. They are also known as perpetual debentures, providing a continuous source of income. Registered debentures. These debentures are registered in the investor's name and the issuer maintains a record of ownership. The issuer maintains a record of ownership, ensuring security and traceability. Bearer debentures. These debentures are not registered in any name, making them easily transferable. Possession of the debenture certificate constitutes proof of ownership, allowing for anonymous transactions. Debentures offer both advantages and risks for issuers and investors. Understanding these is crucial before making any investment decisions. Advantages for issuers include several key points. Firstly, lower interest rates. Debentures often have lower interest rates compared to other forms of debt, making them a cost-effective financing option. This is because they are unsecured, meaning no collateral is required. Another advantage is no asset dilution. Issuing debentures does not dilute the issuer's ownership or control over the company. This is unlike issuing equity shares, which can reduce the original owner's stake. Now, let's look at the advantages for investors. Higher potential returns. Debentures offer higher interest rates compared to secured bonds, providing a lucrative opportunity for investors. This compensates for the higher risk associated with unsecured debt. Regular interest payments. Investors receive regular interest payments, ensuring a steady stream of income. This can be particularly beneficial for retirees or those seeking consistent cash flow. However, there are also risks of debentures default risk. The biggest risk is the issuer's default. If the issuer faces financial difficulties, they may default on interest payments or principal repayment. This can lead to significant losses for investors. Another risk is interest rate risk. If interest rates rise, the value of existing debentures may decline, as investors can find higher returns elsewhere. Therefore, it's essential to weigh these factors carefully before investing in debentures. Section 4. Debentures versus bonds. Many people use the terms debenture and bond interchangeably. While they are similar, there is a key difference. Bonds are debt instruments that can be either secured or unsecured. Secured bonds are backed by specific assets. This provides collateral for the bondholders. Debentures are a specific type of bond. They are always unsecured. This means they are not backed by any collateral. When comparing debentures and bonds, the main distinction is collateral. Bonds can have collateral, while debentures do not. This difference impacts the risk and return profile of each instrument. Section 5. Conclusion. Debentures are unsecured debt instruments. They are used by companies and governments to raise capital. They offer higher potential returns than secured bonds, but they also carry higher risk. Understanding the different types of debentures, their advantages and risks, is crucial for making informed investment decisions. As with any investment, it's important to conduct thorough research. Assess the issuer's creditworthiness before investing in debentures.